afternoon, everybody, or good morning, depending on what time zone you might be joining us from. Good to have everybody here for part three in the trilogy, as John likes to call it, since we're in the process of planning out our June long-term care carrier days that John will be a part of, as will some other carrier partners. We thought it'd be good to sort of kick things off this spring with some conversations about long-term care planning. Never a bad time to have these conversations, right? Long-term care planning and the role that the various long-term care insurance solutions can have. And John's been having a lot of success with this series of three webinars that he's been doing, where he kind of logically takes us through the process of getting ready, getting there, and then actually presenting a solution, which is, I think, what he's going to take some time on today. So, it's one thing to take an illustration and slide it in front of somebody and say, what do you think? But there's a whole different level of conversation that has to take place even before that. And so for the first two sessions, John talked a fair amount about that. How do you have the conversation? How do you frame the conversation? So when you get to the point where you're presenting a solution or solutions, it makes more sense. And that's where we are today and where John is going to take you today. Housekeeping really quick, just so everybody knows, this isn't everybody's first rodeo by any means. So we do have the lines muted just so we don't get any background noise. We are recording the session today, by the way, even though we have the lines muted. If you do have any questions, there is a Q&A box. Go ahead and type your questions into that Q&A box. Just be as specific as you can. So if we don't get to questions until the end, which is typically the way we do it, we'll still know what the genesis of your question was and the specific part you were asking about. So please, please, please do ask questions. John loves questions. So make sure you do drop those into the Q&A box in your Zoom window. We are recording the session today, as we have recorded the previous two sessions that John did, as well as a bunch of the other webinars that we've done here over the last 12 to 18 months. If you do want to review this session, which will take us a day or two to get reformatted and put up on our website, if you go to our website, which is advisorsib.com, and that's advisors with an ORS at the end, so advisorsib.com. If you go into tools and resources, you'll find archived training sessions or archived training webinars in there. This will be added to that, not only to the other two that John did in the previous 2 weeks, but to the rest of the content that we have out there. And there are quite a few out there. So whether it's long-term care related, life insurance related, DI related, annuity related, we got a lot of training out there that you can be tapping into after the fact. Revisit, share it with your colleagues. We encourage you to do that, so take a look. With that, great to have John Gibbons with Mutual of Omaha back with us, and his valued colleague, Amanda Neighbor, formerly known as John Gibbons, by the way, before she changed it on her Zoom window. So great to have both of you here as usual. I think Jennifer is on the line with us today, Jennifer Brown. I'm not sure if Melissa is online with us today. I don't think so, considering the fact that her son is getting married later today. So congratulations to Melissa on Austin's wedding. And Jen was going to try to sit in, but I know she was getting ready to scoot over to that wedding here shortly as well. So at any rate, if you do have follow-up questions, Jennifer or Melissa are your really go-to people to help with that. Certainly you can always reach out to me as well. That's enough for me talking, John. Thanks so much once again for taking time to be with us. With that, I'm going to go ahead and turn it over to you and Amanda. Take it away. Great to have you back here for part three.
All right, great. Thank you, Bob. Quick comment. If any of you are new to New York long-term care AIB, you've got, as he just mentioned, Melissa and Jen are superstars. They know long-term care inside and out. So you have great resources here. Please utilize them across all long-term care products. My background, I've been at Move for 5 years, 4 years, One America before that, and Genworth forever, like 17 years prior. So we want to talk today on how to craft an illustration. As Bob mentioned, the first session was LTC 101, the basics of designing basics of a product and how it works. And again, if you didn't join that session, you wanted to have the replay. Session 2 last Thursday was how to have the conversation, what the risk is, and how to position it and do all that. So now the end of this now is it takes us to an illustration and how to craft an illustration and set this up by the proper demographics. All right. So to get started here, if you have questions, type them in. Amanda and Bob, Bob will keep an eye on them. This is talking about the need, and I actually got this from Lincoln. And it's a nice slide in the upper left-hand corner over here, expectations. 95% of consumers believe their financial professional should be talking about long-term care, or I'd like to use the term extended care planning. So 95%. The reality, 35% of consumers have discussed this with their financial professional. That's it. Big disconnect here. Down here, 66 expectations of professionals say talking about LTC is not a priority. But they believe, the reality was 95% of them believe somebody should have it. All right. You need to be proactive with this. All right. This is critical in retirement planning. The need is there in the expectation. Be proactive. Now, let's talk about cost. So nationally right now, about 113,000 for a private nursing home. And this is national, right? I know and understand that many of you are out in the Northeast, that New York, New Jersey, Connecticut is more expensive. I get it. So I'll try to remember that as I talk throughout this presentation. Home care, 70,000. Now here's the thing, and you may want to write this down. The average claimant is age 80. All right, typically you want people to buy it in their mid 50s if they can. Sweet spot's probably 50 to 64-ish. You can go above and below that though. So what I tell people at times is that the average claimant's age 80, you're talking to them in their 50s. When you go, well, why am I doing that? Well, because you want to buy it while you're younger, while you're healthy, and it's less expensive. All right. Now, so what we have on SPA, if you're appointed with us, our sales professional access, you can go out to that website and click the drop down box here and pick New York, New Jersey, whatever, and say, I want to know what the cost is 25 years from now. And that's what this is showing here, $252,000. So, Mr. and Mrs. Jones, if you have 2 years in a nursing home, one of you, it's over $500,000. Over here, home care. All right, you have an extended event. This is a huge impact to your portfolio. So have that conversation about cost will be in the future. All right. Ways to quote us. One, you can work with Melissa and Jen and the team. All right. You can go to Sales Professional Access. We have a quoting system on there. Now, it's easy to use, but unfortunately, there's no output. You can't save it. You can't print it, unfortunately. You can use a mobile app on your phone. All right. You have WinFlex. That's what we primarily use. You can download WinFlex and run your own illustrations. And there's something else called Insight, which is not appropriate for this group right here, but you have options. We're trying to create our own software. We used to have a software we utilized a couple of years ago that was user friendly. We're trying to create our own right now, and hopefully by the end of the year we'll have that. So creating the plan. The biggest problem that's frustrated me over the years is most advisors, one, are not proactive. Two, when they are, it's just maybe the client called them. So then you go to Melissa or Jen, they give you an illustration. And then what the agent does is just walk through the illustration. And then the client goes, hey, thanks, but that's expensive. Because you didn't do anything. You didn't set the stage. You didn't tell them about the risk. You didn't tell them why they needed it. You didn't talk about the value of the product. All right. You need to have a sales track. And we've talked about this in the last session. But, part of it, your sales track is, I would start one doing field underwriting. And keep in mind, over the years, the two things I've always heard is with long-term care, it's expensive and it's hard to get. Wrong on both counts. It's not hard to get. We only decline 18% of the policies, applications. That's it, 18%. Do your field underwriting. You can make it probably close to 90. Our top agents, ones that do this exclusively, are like at 90%. Even at age 70, we approve 70%. All right, so do your field underwriting. Next is a needs analysis, and this is what we're going to talk about today. Know your audience, and I put it in three buckets: middle class, upper middle class, and affluent. And I'm going to design this differently, and that's important. It's not one size fits all, and I'll address that as we do that. Next, you can tell them there's different options. New York Long-Term Care has all of them. All right. It could be maybe I'm a good fit. Maybe I'm not. Maybe it's life with a rider. Maybe it's life asset based, right? It might be a point where they have an annuity with a lot of gain in it, but they don't need the annuity. Maybe a 1035 that into annuity with long-term care. But just know your options. All right. But here's a big one right here. Cover the salient points. If you want to be good at this, a good thing is kind of know how the product works. And I did that in the first series 2 weeks ago. When I first started at Genworth years ago, I had the money managers, I had wirehouses, Morgan Stanley, Smith Barney, places like that. I had to do a lot of assisted sales because they didn't know long-term care. Many of them still don't. And they had the mindset, what I just told you, well, I don't know much about it. It's hard to get and it's expensive. So I would talk about everything a policy could do for them. The ancillary benefits, many of them are built in, like bed reservations. Care coordinator is huge. This is a concierge service, Mr. and Mrs. Jones. You go on claim. Mutual of Omaha has a care coordinator. It's an employee of Mutual of Omaha, a nurse with claims training that'll help your family through this process, give you insight, give you direction, give you reputable nursing homes and caregiving companies to use. We have a cash benefit that gives a lot of flexibility. There's international benefit. You got home modifications, is it not here? There's a lot of things. And I would build this up, and I could see them going, holy cow, this covers a lot. Yeah, it does. And I was trying to scare them because I wanted in their head going, oh my gosh, this is going to be expensive. And that's exactly what happened. So then there's many times I would say to them, you know what, Mr. and Mrs. Jones, before I show you this illustration, what do you think it's going to cost for the design I talked about? And they guessed most of the time way higher than what I was about to show. Mission accomplished. All right. I didn't hear it was too expensive. I showed the value. Now, again, I know all of you are experts in this and maybe don't want to be, but I'm just giving you some insight. If you want to be really good at it, it's not that hard, not that complicated. Melissa and Jen could really help you with this along with the listening to the series, the replays. All right, let's start with upper middle class because I think that's where most people fall that you're targeting for this. So I've got upper middle class. The goal here is not to cover the entire need. So I talked about national average 113,000 for a nursing home. And I know it's probably 150, let's say, in New York, in the Northeast. I'm not solving for that number. If I solve for that number, I'm going to get no's 95% of the time. All right. So one, I don't need to though, and write this down. Most care is given at home. Right on here, 74% is at home, 13% only in a nursing home. If I don't have a policy, though, it's like 40% at home are in a nursing home. This keeps me out of the nursing home. Mr. and Mrs. Jones, this is anti-nursing home insurance. All right. So I don't need to solve for the 150 or 113,000. Also, people upper middle class, they have some assets of their own. All right. So they can self-fund part of this. So you want to keep this reasonable. You want to, you're trying to cover maybe 67, 70%. And I'll talk about partnership on the next one with middle class. It qualifies here a little bit, but more so on middle class. So this is what I'm thinking about up here. Now I'm going to design this around 5,500 to 6,000, 5,000 to 6,000. So I use 5,500 every time. And talking to Melissa, she does too, even in the Northeast. She'll use 5,500. I would show me personally, I'm not trying to create more work for Jen. Jen, hopefully, she's probably shaking her head if she's on here, or Melissa, but I would suggest you show two quotes. All right. I would show a 3-year and a 4-year for my upper middle class. Let them kind of decide which is affordable. If they pick one, they own it, right? They bought it, it's theirs. And then I would add shared plan to this. And let me explain shared plan. My wife and I buy a policy. We as males, we think we're invincible, right? We don't think it's going to happen to us. Well, you know what? Men get ALS, men get MS, they get dementia, they get all of it. But Mr. Jones, we get it. So here's what's going to happen. You have your policy, your wife has a policy. We connect them with a rider, shared plan rider. Now you have 6 years to share. Their policies, when you design them, have to be identical. 6 years to share. So, Mr. Jones, if something does happen to you, maybe you only use a year of it, and your wife goes to hers, she can come over and use the 2 years left. If you don't use it at all, she can come over and use all 3 years, and vice versa. So keep that in mind. And we as males, then we think about this and we go, well, that's pretty cool. So I don't use mine. I got better, take better care of my wife. Yeah, she's got more coverage. All right. So shared plan. And then joint waiver of premium always with a couple. So inexpensive. And you get a lot of mileage from it. And then inflation, 3% inflation. So if you're not familiar, if I have $5,500 a month benefit, and I buy this in my 50s, but I'm not going to claim to age 80. 5,500 is not going to do a lot, right? At age 80. So I and we had inflation. 3% compound is the norm, and that's going to just about double in 20 years. It'll double by 25. All right. So now I have good coverage when I'm 80 years old. So we had 3% inflation. Now, if I'm talking to somebody that's 60 years or older, I can have my inflation stop after 20 years, 15 or 10 years, instead of going through my lifetime until I either claim or until I pass away. And I use this for age 60 and above. So if I have a 60-year-old, remember the average claimant is age 80. I'm going to put that 20-year inflation on there. So inflation stops growing when I'm age 80, and that saves me as a couple like $1,000 to $1,300 a year. If I have a 65-year-old, I can use 15-year. I'm 70-year-old, 10. All right. We're the only traditional carrier that has this. This is a good way to keep those premiums reasonable. That's the value prop of traditional long-term care. There's asset-based products out there, good products, good companies, but they're very expensive. We're pure insurance. We want to keep this affordable. It's like term insurance versus permanent. All right. Now, here's another thing to address in the red down here. One objection people give with traditional long-term care is, hey, John, premiums aren't guaranteed. And I understand that. And older policies have been hit with increases in premiums, especially Genworth has been crazy with it. We've been pretty judicious and not done it a lot, especially in New York, maybe once or twice over 38 years. All right. But, and we now have 38 years of experience. We repriced our product 2 years ago to address anything that we think could impact having to cause a rate action, an increase in premiums. So we feel really good about this product, so you should too. Now, I can't sit here and say, hey, we'll never increase the premiums. I couldn't do that to you. My job is to make you look good. I can't promise that. But I can say there's a good chance there wouldn't be. And if there was, I don't think it'd be very significant because of everything we've done and all the data we have about it. We no longer have lifetime coverage. We don't offer that anymore either. And we have gender specific pricing along with other things we have done. But one way you can mitigate that, if it's an objection and a concern for your client, is do not add the inflation protection, just increase the monthly benefit. So instead of $5,500 a month benefit, maybe I start with 10,000 or 11,000 and no inflation. None. Now, if I end up having a stroke at a younger age, at age 60 or something, I'm covered. I already got 10 or 11,000. I don't have to worry about the growth. It's already there. But if we do increase premiums on this down the road, much less chance we would do it with one with no inflation on it. So just keep that in mind as another way to help mitigate that concern. Now let's talk about affluent. Here's the thing. Wealthy people will look at this. Some will summarily shut you down. Don't let that discourage you. But many of them understand the concept of other people's money, leveraging, and pennies on the dollar. They're smart people. And they typically have a tipping point, all right, where they're going to go, I'm not going to pay that much. If it was reasonable, I'd do it. For that much, I'll roll the dice. I'm going to self-insure, self-fund it. All right. That's okay. So when I first started covering the wirehouses and I had affluent people a lot, I would kind of make this robust coverage, thinking that's what they wanted. And I was getting a lot of no's. So I had to adjust. And I did. So then I started showing them the same or very similar to upper middle class. And I told them that. I said, Mr. and Mrs. Jones, you have assets. You could self-insure this if you want. Not a good move. Smart to look at this and transfer the risk, but you could. So what I'm going to show you is similar to what I would show upper middle class. All right. I'm just trying, it's like a discount coupon. I'm just trying to keep the dam from breaking. And all of a sudden I was back to selling 70% of them in the first meeting. All right. And only one time in the 2, 3 years I was doing that, did I have somebody go, hey, John, I like the nicer things. I can afford the nicer things. I can pay for them. And I do. I want more coverage. So what did I do? Showed them more coverage. But if I would have started high, like I do with everybody else, I would kept hearing 90, not 90%, but a big significant portion of it say, I'm not going to spend that much. You can't go down because then I would say, well, let's lessen the coverage. Well, no, then it's not good coverage. I don't want it. You can go up. It's hard to go down. They say no, you're done. All right. That's very important to understand. And if you don't believe me, then show a good and a best. All right. Or a better and a best or whatever. Show two. Like I talked about with the upper middle class, show a 3 and a 4 year. So you got the tipping point. So I might use 7,000. I probably wouldn't go to 8. I'd go 7,000. And use that, and maybe 7,000 and 5,500. I'd probably show them both. And then maybe a 4 and a 5 year. Shared plan, absolutely. Joint waiver of premium, absolutely. I'm going to keep it at 3% compound. If they ask for more, that's fine. And then explain what I did. Now, here's the thing. A few stories. When I was with Gemworth, we had somebody come to us, an agent, had a client with a $40 million net worth. 40 million. The reason they were looking at it is their mother had been getting care at home for 10 years, was now in a nursing home for 2 years at the time. And even though this was stories 20, 25 years old, it was $100,000 back there in Tennessee because they knocked out a wall and she had 2 rooms. They bought long-term care insurance. Could they have self-insured? Absolutely. Whatever hers cost was not a dent in 40 million. They bought it because they thought it was a smart business decision to transfer the risk. And 2 years ago, That agent called me and said, "Do you remember the case?" I said, "Absolutely." One of them just went on claim. Smart business decision. When I first got here 5 years ago, somebody sold a client with a $50 million net worth. So naturally, the question was, why'd you buy it? And I got the feeling maybe, very wealthy people, families can be dysfunctional, right? He felt that his kids maybe would be more concerned with the money than him if he got ill. This is short-term coverage. And then one last one. Similar with this couple had through real estate, self-made millionaires like 7, 8 million. And this is another 20-year-old one, so it would be equivalent now, whatever, 10, 13 million. And asked her why, and she said, one reason is my husband doesn't take good care of me, so I want coverage. Two, why would I give my money to the healthcare industry? I worked hard to build this. When I could transfer the risk, at the time it was Genworth pay for this. And I thought that was very profound and a good way that's never escaped me, a good way with wealthier clients. Yeah, you could, sure, you could pay it yourself if you want, but why give your money away? Take the leveraging. All right.
John, you have some questions, if I could stop you here.
Okay.
So with Esther, I did confirm the shared care. She just had asked about combining the amount, not the years. But then she came back and asked if they buy 3 years each, they have access to 6 years. So if we can go a little more in depth about shared care. You called it shared plan, but it is in fact shared care. So kind of go in depth a little bit more about what shared care is.
So a shared care, if let's say I'm alive, we have to have exact same coverage. I have 3 years, my wife has 3 years, same benefits, $5,500 a month, 3% inflation, connected with the rider again. We have six to share. If I'm alive, let's say the other way around. My wife's alive, I go through all of my benefit. I can tap into hers, but if she's alive, I have to leave her 1 year of her 3 years of coverage. If she's passed away, I can come over and use all three of hers. I've got 6 years of coverage now, and vice versa. So the really way it works is Mr. Jones uses only a little bit or doesn't use any. My wife can come over and use all of it and potentially have 6 years of coverage now. So we're sharing our two pools, making it one pool of 6 years to share. All right, next question.
And then she has, can you explain a bit about joint waiver of premium?
Yeah, so if I go on claim, what built into the policy is if I go on claim, I don't pay my premium. If I add the rider for joint waiver of premium, I have a policy, my wife has a policy, I go on claim, I don't pay mine, and with joint waiver, neither is my wife. As long as I'm on claim, she's not paying. If I get healthy, I start paying mine, she starts paying hers. Or if I pass away after my claim, then hers kicks back in. But when one of us is on claim, neither one pays. It's very inexpensive. And I'll show you an illustration in a little bit. It's like $100, $150 a year total, and you get a ton of mileage out of it.
That was all the questions, John.
All right, cool. All right. So, oh, wait a minute. All right, middle class. And this is important. This is where people get tripped up. And they'll try to design it the same as upper middle class. And they'll go, well, John, like down here, I have it like 3,000, maybe 3,500 I would use. That's not enough coverage. Okay. If you show them $5,500 a month and 3 years and whatever else, what do you think the answer is going to be? It's going to be no, I can't afford that. So then what do they have for coverage? None. Something is better than nothing. So know what their situation is. Do they have a pension? If they have guaranteed pensions, they probably need less anyways. What can they afford? All right. So I'll give you an example. my mother had MS for 40 years, was in a wheelchair the last 20, so my father's whole retirement was a caregiver, and me and my four sisters would help. Um, so I'm going to talk about partnership here. So for partnership eligibility, let me back up a second first. Partnership is an agreement between the states and federal government that if I buy a long-term care policy, tax qualified long-term care, and this only works for traditional long-term care, not asset-based, and I have like a $200,000 pool of money, and I go through all that, and now I have to use my own money, and I have a $500,000 net worth, including home equity. I can spend down my assets, protect 200,000, set it to the side, and go on Medicaid. If I had purchased a $250,000 pool of money, I could have protected 250,000. It's dollar for dollar. All right. So now, if I buy a policy and I have the inflation protection, it's free. It's not in New York and it's not in Connecticut right now, for us anyways. It's in New Jersey though. If I design my policy with the right inflation, it's free. I automatically have this coverage. I can go on Medicaid and protect assets. So when my father realized that at some point when he passes away, that we'd have to use the home equity to take care of my mother, he was devastated. They wanted that home equity to be their legacy to me and my four sisters. His father was blue collar, and that's what his dad did for he and his siblings. This is a big deal. Some people dismiss this. Don't dismiss it. All right. So it's called partnership. Um, and it depends. I don't know about New Jersey, what's needed there off the top of my head, but it's each state has somewhere between 1% and 5%. Some states say it's got to be 3% or more. If you design it right, it's free. All right. So my design here, $3,500 a month. Now I'm going to show a 2-year and a 3-year event. No shared plan here. No shared care. All right. It's like $1,300, and I got middle class here. I want to keep this reasonable. No shared care, but 2% inflation. I'm going to knock it down to 2% and joint waiver of premium. This is important to design it appropriately so they'll buy it and protect themselves. So I forgot to get to the end of the story so my mother, we run out of money. Father passes away, we run out of money. My mother ends up in a Medicaid nursing home because we ran out of money. If she had $3,000 a month benefit on top of my father's pension, she would have had enough money to stay home and not had to go to the nursing home. So yes, it is enough money. All right. Something's better than nothing. All right. Now we have two products, custom and secure. Use custom. Years ago, secure was the one we made changes, use custom. Custom has more inflation options, has more elimination periods built in, has the buy up and buy down. This is free. Buy up means on my policy anniversary, I can increase my inflation with no underwriting. So if I have 3% inflation for whatever reason, I want more coverage, I want to go to 4% or 5%, I can do that. I can buy more coverage. And it might be a good thing to do if you think you're going to claim soon, because then once you go on claim, it's still growing and you're not paying any premium. I can go up for the first 20 years that I own that policy or until I hit age 75. Okay. After that, it locks in. I can always go down. Any age, I can reduce it. Joint waiver of premium, and that's not on secure. And then full return of premium is not available on secure. Only custom has that. Now, top riders, I talked about shared plan, about 15 to 16%. Joint waiver of premium, 2%. We have a security benefit. My wife and I apply. She gets declined. All right. She gets declined. Or like my mother is ineligible to apply because of MS. On the healthy person, we can add the security benefit. It's 60% more premium. That's still less than me and my wife buying it. But I get 60% more coverage if I go on claim. So for an example, I have a $10,000 monthly benefit. I'm on claim, I'm using all 10,000. Mutual of Omaha is going to give me an additional 6,000, 60% of that cash. I don't need any receipts. Do whatever I want with that. I can go buy a new car. But theoretically, that's there for to care for my wife. Now, if she doesn't need care yet, I can bank that. End of the year, I got 72,000. End of 3 years, I got over 210. So we're to only carry with us in a way to kind of try to help an unhealthy person. Full return of premium, you have to buy it age 64 and younger. You can claim on it at any point, just have to buy the rider 64 and younger. Professional home health care. This one, it's got some value. I try not to add too many riders. I want to keep the premiums reasonable. Now, if I'm dealing with upper middle class or fluent and they're not premium sensitive, I would add this. It doubles my monthly benefit. So if I have 10,000, now we have 20,000, but I can only use it for professional care, meaning um, nutritionists. Uh, I get a nurse for 365 days. I get like for part-time care, and that can be a full nurse. I can do it for physical therapy, occupational therapy. All right. It's very inexpensive. It's 3%. I can get waiver of my home health care elimination period. I don't add this too much unless somebody really wants it. I still think 1450 it's just not worth the value. I don't think people are worried about the first 90 days. They're worried about the next 2, 3, 4 years. But what this would do is I have a 90-day elimination period. It makes it 0 day for home care. There if I want it. Two that I don't touch ever is survivorship and non-forfeiture. They're not real expensive, but there's no value to me. It's not worth paying that much extra. Cost of waiting. You could do this on your own, but I would kind of, let people know if they're procrastinating. If I don't buy this at 55 and I wait 5 years for this design I have on here, it's $1,000 more. But look what happens. If I buy it at 55 and I have 66,000 monthly benefit, at age 80, it's 12,000. It's doubled. If I wait 5 years, I've lost the leveraging of 5 years. I only have 10,000 monthly benefit. If I wait 10 years, almost 3,000 more. And I lose my leveraging. So cost of waiting. We've got a good e-app. I encourage you to use our e-app. And we have training tools around that. Processing. So you sell this. You show the illustration, they buy it. Our cycle times are way down. We go through this very quickly. We've brought everything in-house. So when an app comes in, sometimes it's looked at already within 4 hours. All right, it's in the system right away. 4 hours, new business can look at it, have it cleaned up, make sure it's good to go in like a day. Underwriting can look at it within a day, and within a day make a decision. So sometimes if people are age 59 and below and healthy, we can waive the phone interview, we can waive the medical records. The policy could be out the door in like 4 days. That's the new norm. All right. The days of 90 days of waiting to get your policy, that's the extreme. That's rare. Our average cycle time is like 28, 30 days right now. If you're younger, like I said, it's out the door quickly. All right. Next, before I show this, let me pull up an illustration. So here's an illustration. We've got male age 55, female age 55. They've got 3 years of coverage at $5,500 a month benefit right here. So when you take that $5,500 a month times 3 years, so times 36 months. That gives you this $198,000 pool of money. Your coverage is done not when the 3 years are up, it's when the $198,000 has been exhausted. So if I'm getting care at home and I'm not using my full benefit on my full 5,800 or whatever that number is, it stays in my pool of money. If I'm only using 3,000, the 2,500 extra is not gone. It stays in my pool and it just lasts longer, and that happens a lot. So in this case, we've got a cash benefit we've talked about in the past with our policy. I can pay my wife, my adult children, anybody I want cash up to 25% of my benefit. So in this case, we're saying you can use $1,375 a month to pay anybody you want. Because normally you have to go to an agency. All right, so I've got that. I've got a 90-day elimination period. We'll start paying after 90 days. Partnership qualified, yes. 3% inflation with the buyout. And then I said no to a lot of these riders, yes to joint waiver of premium for both of them. No, 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 yes to shared care. And then here's my couples discount. We both apply, we're both approved, we get a 15% discount. If only one spouse is applying or only one's approved, it drops to a 5% discount. So combined, here's their monthly premium, $646,000, $646. So here's their annual premium, $7,100, semi-annual, quarterly, and then. So you have everything in a snapshot right here, very easy to explain. Now, next page will break down by husband and wife what the individual riders cost. You can see joint waiver of premium here, $4, $7, all right? Shared care. So this breaks that down in case you wanted to add or take something out. And this is the only other page I would show. Here's my monthly benefit, $5,500. In 10 years, it's $7,160, $76. In 20 years, I'm up to $9,600. And my pool is growing also to $347,000. If I wait 25 years, when I'm age 80, I'm at $11,000 a month. It's great coverage, right? I've got 400,000 pool. Between the two of us, we're over 800,000 coverage. So I would, show them that growth. So let me take a pause. Any questions there?
No, I don't see any further questions. Let's see if there is any.
I
Okay.
think you're on top of them.
Okay. Let me go last slide then. We'll wrap this up. So here's your call to action. You just invested 45 minutes of your time. You got great resources here, as I mentioned. Look at your book of business. 50 to 65 is the sweet spot. All right. Look at your book of business, then look at business owners in that sweet spot because they have tax favorability or they can write this off. Business owners love running things through their business. Take advantage of that. And if you're not familiar with it, Jen and Melissa can help you with that and show you to get you the tax guide. If you get single females in your book of business, 60s and or 70s, I guarantee you they're worried about this and they don't know they can get it if they're healthy. Do your field underwriting. We talked about wealthy clients. But the key here is be proactive, not reactive. This is critical in retirement planning. Can you tell how many people I've talked to over the years, said, John, we went through $2 million. A lot of people go, we went through all of it, whatever that number that is. Most I've heard is 5 million. And then a few years ago, 2 years ago, I was on a panel and somebody said 4 million. Could have been protected easily. All right. Last thing I'll say, and I'll throw it back to Bob, is think about who you're going to talk to over the next 2 weeks. Clients or prospects, and get with Melissa and Jen, and they'll help you craft an illustration perfect for that individual, whatever demographic, and be proactive with this, not reactive. Bob, throw it back to you.
All right, John, thanks. Appreciate that. And Amanda, thanks for fielding some of the questions. Just as a follow-up to that, I know Esther had asked a follow-up question about the illustration and how you ran the illustration that you showed. Maybe you could forward that if you still have it. Maybe
Yep.
forward that with the copies of the slides when you send them over to me, and I'll share that with the entire group today. And I know Amanda had said, Esther, that you can go to winflex.com. You do have to get some clearance to be able to run illustrations through WinFlex. You're certainly welcome to do that, but as John has mentioned a number of times, both Melissa and Jennifer here can run those for you as well, and we're happy to do that. So either way, if you want to play with the software, we can get you in there and you can run it, or we'll be happy to do it for you. You covered a lot of ground as usual, John, and thanks for pointing out a couple of things that, I mean, that the buy up, buy down inflation is a key feature of Mutual of Omaha's policies. I also want to point out to folks and reinforce the fact that one of the things I would suggest that you do, and I've said this before, I think there's this knee-jerk reaction that, oh my goodness, you never include return of premium on traditional long-term care insurance. It makes it ungodly expensive. Well, one of the things that you might find of interest, if you're looking at comparing traditional long-term care insurance to, say, a life insurance policy that has one of the living benefit or acceleration riders, where you can accelerate the death benefit to pay for long-term care or chronic illness, have that run, and then look at a traditional long-term care policy for Mutual of Omaha with the same amount of pool of money for long-term care, and that would typically match the death benefit on the life insurance, but then run it with or without return to premium. I would suggest run it with return to premium, but run it without inflation. Now that might be counterintuitive. A lot of people say, why would you sell it with no inflation? Well, if you're selling a level death benefit life insurance policy with a living benefit or acceleration rider, you're essentially selling a non-inflated long-term care benefit. But we don't always think about that with the traditional product. So look at the two of those side by side. I think you'll surprise yourself and you'll find that the premium for the traditional long-term care with return to premium but without inflation is going to be very attractive compared to the premium for the life insurance with the acceleration rider. And we can run those for you if you want to see that. I've shown those a number of times, and I've always gotten kind of the shaking of the head like, gee, I never thought of that. So happy to do that for you. Last chance for questions, gang, before we cut John and Amanda loose. And I do mean cut them loose because this is part 3 of 3, and they're probably tired of us by now. So
Not at all.
Never.
Never.
so I don't see any other questions, John. So I think I'll just remind everybody, if you do have questions, hey, go ahead and send those over to me or us. We're happy to field those questions. As always, appreciate the support both from John and Amanda. I mean, Mutual of Omaha is one of our strongest carrier partners, and is in particular on the long-term care side. And we just so appreciate the support that you guys give us. So thanks so much for that. With that, John, I'll give you and/or Amanda the last word before we cut everybody loose.
I'll just say, hey, again, be proactive, and we do pay commissions. So
I heard that rumor.
yeah,
We
yeah,
we do
I know
hand
you're
out
doing it.
money.
I know you're doing it for benevolent reasons, but we do pay commissions. So yeah, go for it.
Duly noted. We'll actually talk about that at the carrier days for those of you in the areas, New York and Pennsylvania, where we're going to be doing the carrier days. And in fact, we're going to have a sales incentive going on as part of that here the first 2 weeks of June. So wink, wink. Some even better news coming on that regard. Okay, I think that's it. No other questions that I see. Amanda, thank you. John, thank you. Thank you for this whole series, John, of the 3 sessions. So powerful, and you brought up so many good points. I'd have to take my shoes off to count them, and I'd still be way short. So thanks, guys. Really appreciate it. Thank you, everyone, for attending. Once again, give us a day or so, and we should have the recording up at our website. So if you want to review it, share it with colleagues, you are welcome to do that. We encourage that. So with that, I'll close it up. Thanks again, guys. Thanks, everybody, for being here. Take care. Have a great rest of your weekend. We'll be back with you next week. Take care.
Take care.